Let's be honest, the purpose of investing and trading in shares has one sole objective: making profits and becoming richer. As a successful investor, your goal should be to gradually grow your portfolio and ultimately reach a point where your investment becomes your main source of income. Well, this might not be as easy as it sounds, but it's not impossible. It just takes a bit of learning, understanding, patience, and sometimes a bit of trial and error. I myself have made a handful of mistakes on my journey, but I have learned from all of them, and it's all part of the game. In this video, I want to talk to you about strategically building your portfolio of shares. So, let's get right into it. The first thing you need to do when building your portfolio is to decide on which shares you're going to invest in and the amount of funds you want to allocate to each investment. This breakdown of your portfolio is what makes up your strategy as an investor. Each investor's portfolio will look different, but at the end of the day, the goal is to make it as profitable as possible. If you aren't willing to spend some time deciding on what your strategy is going to be, you might be much better off investing your money in safer, fixed income securities like bonds or fixed deposits. These won't really make you any crazy gains, but you'll at least earn a fixed income from the interest they pay. Here are a few things to take into account when building your strategic portfolio. Dividend investing. If you're an investor who doesn't have much time to do your own research or even the time to actively trade in the market, your best bet might be to invest in companies that pay a healthy dividend each year. Make sure that these companies have been consistent in their dividend payouts and that they pay a significant portion of their income as dividends to shareholders. I would advise you that you also consider the company's dividend yield. This is the dividends the company pays out as a percentage of its share price. This is higher than the fixed income you might make investing in bonds or fixed deposits. It's a good place to invest in. An investor aiming for dividend returns doesn't need to pay much attention to the company's share price in the short term, as long as the company is performing well financially and keeps paying out a consistent dividends. But don't get complacent. Read every notice and announcement that the company issues and analyze how it may affect your share portfolio. For example, if a company announces major expansion plans, this might require them to retain a lot of cash to invest in these expansions, and this might in turn result in a lower dividend payment. I would advise you to spend a few minutes each day checking for any company announcements on your share trading platform. These announcements are usually available under a section called Company Announcements. Another thing to remember is that dividend-paying companies can also give you capital appreciation. This happens when the share price moves up much higher than the price you bought it for. This often happens because companies that consistently pay higher dividends attract more and more investors, increasing demand for their shares and therefore driving up the price. Dividends are also a great safeguard for investors starting out in stock market. For example, say you invested $5,000 in a high dividend paying company and the share price drops in the short term. In most instances, this might be a cause for panic, but if the company pays out a dividend yield of say 10%, you know that you're going to at least make $500 in dividend income. Your investment hasn't gone to waste, and if the company is a healthy, well-functioning company, the share price will eventually rise back up again. Capital growth shares. Now you might be thinking, wow, this dividend strategy sounds great. And it is, but there's a reason why seasoned investors don't invest all their money in high dividend paying shares. This is because they have more experience and therefore a higher risk tolerance. And the more experience you gain, the less satisfied you are likely to be with average returns. Most experienced investors often aim to at least double their investments over time. The thing about the stock market is that the risk and returns are often positively correlated. The higher the risk, the higher the potential returns or losses. Examples of riskier companies to invest in are companies that are just starting out or companies that are about to embark in new directions. These investments can either go really well or really bad. So, it's important that any risk you take are calculated. For example, during the start of the COVID-19 pandemic, the share prices of many companies tumbled, wiping out huge amounts of wealth in the short term. But some companies bounced back incredibly fast and their share prices flew through the roof. The investors who spent time to identify these opportunities are probably millionaires by now. When it comes to investing in riskier companies, one thing I would suggest is to only invest an amount that you can afford to lose, nothing more. Don't make the mistake of seeing potential for extraordinary gains in a share and going all in with your money. This isn't poker. As a strategic investor, you should always be hungry for profits but never greedy. Investment horizon. Another important factor to consider when building your portfolio is the time frame you want to be investing for. You should always have a target of how much return you want to make on your investment and the period you want to achieve this in. You might also want to keep in mind any other investments you want to make in the future, like your dream home. So, always strategize your investments with a rough timeline. If you have a short-term investment strategy, you might not need to think too much about the long-term prospects of the company. In such an instance, your strategy should be to pick a good price to buy a share at and then sell it when you've made an adequate return. A 5% return over a couple of weeks on an investment is still better than putting your money in a savings account, which pays you less than 1% a year. This is actually how those big banks make their money. They invest your money and make huge returns for themselves, while sometimes paying less than 1%. If you intend on investing on a company for the medium to long term, you absolutely have to do a bit more in-depth research. You will want to know what the company's history has been like, what its future prospects are, and finally, how long you intend on holding this investment. A medium to long-term investor would not pay much attention to the short-term price movements. End goal would be based on a possible lucrative future potential. This is kind of like a miner putting in years of hard work to finally hit that rich vein of gold. Remember, everyone's portfolio doesn't look the same. It can differ from person to person based on their knowledge, area of expertise, lifestyle, and even age. I would suggest that you always give first preference to researching companies that you can easily understand. For example, a doctor or any other healthcare professional would be able to gain a better understanding of a biomedical company than a lawyer. An IT student may have a better understanding of a tech company than a business student. So, pick an industry in your niche and identify stars in it. You can't go wrong doing this. I hope you have learned something new today. And if you haven't done so already, I hope you would subscribe to this new channel of mine. I appreciate all your help, and each like, comment and subscription goes a long way. I'll see you on the next video.